Right, so today we're diving into purchasing power parity. It's often shortened to PPP, that's a big deal in math or economics. Really important for figuring out how much stuff actually costs in different countries, especially when you're dealing with all those different currencies around the world. Think of it this way, like imagine you want to compare how expensive it is to live in, say, New York City versus, I don't know, Lisbon, Portugal. You can't just look at the exchange rate between the dollar and the euro, right? PPP helps to level the playing field. It's basically the magic exchange rate that would make a basket of goods, groceries, rent, that sort of thing, cost the same in both places. That makes it super useful for comparing things like, say, how big different countries' economies really are, their GDP, but in a way that takes into account the real cost of living. Read unpack how PPP works, look at how it's used in the real world, and talk about why it's so crucial for understanding the global economy and those tricky currency risks. And hey, while you're at it, if you're finding this interesting, hit that like button and subscribe to the channel. So let's get down to the nitty-gritty. What exactly is purchasing power parity? At its core, it's about making sure we're comparing apples to apples, so to speak. When we look at the cost of stuff across different currencies, the purchasing power parity index, that's the tool that actually gives us the exchange rate, that does just that it evens out the buying power of different currencies by taking into account how prices differ between countries. Like economists will look at what a set basket of goods, think everyday things people buy costs in one country versus another. Then they'd use the PPP exchange rate to adjust, say, one country's GDP so we can accurately compare it to another country's. And this isn't just theoretical. PPP calculations could be used for everything from a single item to a whole country's economy. Okay, so we know what it is, but how's this whole PPP thing actually used out there in the real world? Well, for folks in the investing game, understanding PPP could be a pretty handy tool, especially for foreign exchange trading, helps them spot currencies that might be overvalued or undervalued over the long term. It's not just for currencies, it's useful for analyzing foreign investments too, because when you consider the real purchasing power of currencies, investors can get a clearer picture of what assets are truly worth in different countries. Now, multinational companies, those with operations all over the globe, well, they also need to keep an eye on PPP because of something called currency risk. This can seriously mess with their earnings down the line. If exchange rates go haywire, the value of their earnings from different countries can really change when they convert it back to their home currency. It's a big deal. Now, there's something important to understand when we're talking about PPP. There are actually two main types: absolute PPP and relative PPP. So absolute purchasing power parity. That's all about comparing the actual price levels between two different economies at a specific point in time, like right now. What we're looking for is that exchange rate that would make the purchasing power of their currencies exactly equal, like a perfect balance. Relative purchasing power parity, well, that takes a bit of a different approach. It focuses on how inflation affects prices over time. Relative PPP helps us figure out how much prices in different economies should change based on their different inflation rates. Think about some countries, places like Brazil or Turkey. Historically, they've had pretty high inflation. So if you just look at absolute PPP, their goods and services might seem really cheap. But with relative PPP, that takes into account those big inflation differences and helps you figure out if their currency is actually undervalued compared to other countries. It's like adjusting for the fact that their prices are constantly on the move. That distinction is super important for getting a true read on how currencies are valued. PPP is really crucial for understanding the bigger picture of the global economy. Developed economies, they usually have higher prices, and it's more expensive to live there compared to developing economy. Now, that might seem a bit odd, but it's often because those developed economies have higher average wages, better infrastructure like roads and airports, and more sophisticated financial markets, so things balance out. The interesting thing is when we factor in purchasing power parity, developing economies tend to play a much bigger role in the global economy than you might think just by looking at their GDP numbers. For instance, there's a report from the IMF, the International Monetary Fund, that said China's actually the world's largest economy now when you look at things through the lens of PPP. And it doesn't stop there. The same report projected that by 2050, India is likely to be the second largest economy globally using PPP calculations, with Indonesia and Brazil also expected to climb into the top 5. This means they might even overtake some of today's leading developed economies. Pretty wild, Frank. Now, it's super important to remember that these calculations are all based on those PPP adjustments. If you just look at regular GDP figures, those based on current exchange rates, you get a totally different picture. So thinking about the global economy through the lens of PPP, it's a whole new perspective. It can help investors find opportunities and spot growth in places they might otherwise miss. Right, now let's zoom in a bit and think about what shakes individual countries' economies. Why? Because all these factors end up having a huge impact on how strong a country's currency is. So many things can influence whether a country does well or not economically. Like how educated their workforce is, the quality of their infrastructure, like their roads and power grids. Then you have how stable their government is, how effectively they enforce contracts and uphold the rule of law, the monetary policies set by their central bank, and the fiscal policies put in place by by the government. And let's not forget about deficits, both in trade and government spending and how they manage their natural resources, whether it's oil or minerals or whatever. This isn't even an exhaustive list, but it gives you a sense of the key ingredients in a country's economic recipe. Now, when we're talking about the strength of a country's currency and its overall purchasing power, some of these factors are especially critical. For example, a country's fiscal and trade balances. Those are like vital signs, telling us a lot about the health of its economy and the strength of its currency. Let's dig a little deeper into how trade affects currency values. A country's fiscal balance, that tells us whether their government is spending more than it's bringing in a deficit or bringing in more than it's spending a surplus. Now, if a government keeps running big deficits year after year, eventually they're going to need to borrow money, either from folks within the country or from international organizations like the IMF. Now, if they're borrowing a lot from foreign investors, well, that could put downward pressure on their currency. Why? Because they'll have to pay interest on all that debt, which can lead to inflation, prices going up, or they might have to implement austerity measures, which are basically spending cuts and tax hikes, and they can also drag down the value of their currency. Investors also watch a country's trade balance like a hawk, because basically the difference between what they're selling to the rest of the world, their exports, and when we're buying from other countries, their imports. A trade surplus, that means they're exporting more than they're importing, which is generally a good sign for a currency. It basically means more money and assets are flowing into the country, which strengthens its economic foundations. On the flip side, a persistent trade deficit where a country is importing more than it's exporting, well, that tends to weaken their currency in the long run. Why? Because at some point, those foreign investors who are selling them all those goods are going to want to get paid. And to do that, the exchange rate often has to adjust downwards to strike a new balance. Now, currency markets will be super unpredictable in the short term. If you look at long-term trends, countries with trade surpluses usually have strong currencies, and those with constant deficits tend to see their currencies weaken. Here's the catch, though. Things work a bit differently when you're talking about a country with a reserve currency. Historically, big, powerful countries, like France and Britain back in the day, they could run big trade deficits for a while without their currencies canky. That's partly because of their military might and their influence on the world stage. Some folks argue that the United States has been able to get away with running both fiscal and trade deficits for so long because the US dollar is the world's top reserve currency, and let's be real, because of America's global military power. And don't forget, the huge chunk of global trade, especially for things like oil, is done in US dollars. This gives the dollar an extra edge that your typical economic models, like those PPP indexes, don't fully capture. But for countries that don't have a reserve currency, well, if they keep running those physical and trade deficits, their terms of trade, what they get for what they sell, are probably going to take a hit over time. All right, so now let's talk about currency risk. This is something that anyone involved in international trade or investment needs to wrap their heads around. Currency risk is that nagging fear that even if you make a sound economic decision, it could all go south because of sudden, unexpected shifts in exchange rates. Imagine a steel producer who's expecting a 10% profit margin on a shipment overseas. Sounds good, right? But if the exchange rate between their currency and the buyer's currency changes by 10% between when the steel is shipped and when it arrives, poof, their profit vanishes. Just like that. Or take an investor who buys bonds from a foreign country, thinking they'll get a nice interest return. But then the value of that foreign currency takes a nosedive when they convert it back, wiping out all their gains, and they might even end up losing money. It's tempting to think that this currency risk is only a big deal in countries that have had hyperinflation, like Zimbabwe or Argentina. In those cases, definitely illustrate the point. Just look at the Argentine peso. Back in 2001, it was equal to the US dollar. But today, you need something like 1,000 pesos to buy a single dollar. That kind of dramatic collapse creates huge headaches for businesses and investors trying to plan for the future and make contracts in that currency. But here's the thing. Currency risk has become increasingly important for major developed economies too, especially since we moved away from the Bretton Woods system back in the 1970s and saw all that inflation. With all the inflation and volatility we've been seeing in commodity prices lately globally, there's a real chance we could be in for even more instability in exchange rates across the board. So in this kind of environment, where currencies can swing wildly, purchasing power parity can actually be a pretty useful tool for spotting potential currency risk. If a country's relative purchasing power is looking pretty low, especially compared to other countries at a similar stage of development, it's often a sign that their currency might be overvalued. And that overvaluation, it can make their economy less competitive in the global market, potentially leading to a currency devaluation down the line. Central banks, especially in developing countries, sometimes decide to devalue their currencies to boost their competitiveness. The idea is to make their exports cheaper and their imports pricier, which can help boost their economies and improve living standards. By paying attention to those relative PPP metrics, investors could sometimes anticipate brewing currency risks before they blow up into a full-blown economic crisis. To really grasp how purchasing power parity works on the ground, let's break down the basic formula. At its simplest, you calculate the PPP of a specific good by taking the price of that good in one currency and dividing it by the price of the same good in another country. You've probably heard of the Big Mac index. It's a famous example. So So imagine a Big Mac costs €7 in Germany and €5 in France. The PDP ratio for those Big Macs would be 1.4, meaning things are a bit pricier in Germany in this very simplified example. But when you're talking about a whole economy, statisticians have to get a bit more sophisticated to put together a basket of goods and services that represent what typical consumers spend their money on. It's similar to the baskets they use to figure out the consumer price index, or how much inflation is happening. Then they figure out how much it costs to buy the same basket of goods in a bunch of different countries using each country's local currency. To make sure they're comparing apples to apples, they convert the total cost of each basket into a common unit, usually US dollars, so they can measure and analyze the data. If we peek at the International Monetary Fund's predictions for 2024, they actually rank the top 10 largest economies in the world based on their GDP, but adjusted for purchasing power parity. And the list is pretty interesting. Number 1 is China, then it's the United States, India, Japan, Germany, Russia, Indonesia, Brazil, France, and the United Kingdom. Now, is anything? Countries like China and Indonesia, they jump way up the list when their GDP is adjusted for PPP compared to their regular GDP numbers. That's mainly because a dollar goes a lot further in developing economies. You can buy more stuff with it there compared to the US, or a lot of developed European countries where the cost of living is higher. Okay, as we wrap things up, it's super important to remember that purchasing power parity isn't the be-all and end-all for measuring how wealthy a country is or how much its people earn. But it does give us a really useful way to look at the real buying power behind a country's economic activity. PPP can also be a handy tool for comparing salaries and wages around the world, since it takes into account how much things cost in different places. And here's another interesting point. If there's a big gap between a country's per capita GDP based on PPP and its reported GDP per capita using market exchange rates, well, that could be a sign of their currency is either undervalued or overvalued on the foreign exchange markets. Savvy investors use this kind of information to figure out how to protect their international investments from potential currency swings. At companies that are doing business globally, well, they can try to hedge against volatility, especially when it looks like a currency is way off based on PPP. So let's recap, shall we? We explored purchasing power parity as the special exchange rate that makes a basket of goods cost the same across different economies. We talked about how it's used by investors, multinational companies, dug into the difference between absolute and relative PPP, and highlighted how crucial it is for understanding the true size and potential of developing economies on the world stage. We also touched on those factors that shape a country's economic health and currency strength, like their fiscal and trade balances, what it means to have reserve currency status, and the always present risks that come with currency fluctuations. And to wrap it all up, we looked at how PPP can be a signal for a potential currency risk, and we saw how it plays out in the real world, with examples like the Big Mac Index and the IMF's latest projections for GDP based on purchasing power parity. Take a moment and think about how factoring in these PPP adjustments might change your view of how big and influential different economies really are, and where the best investment opportunities might be hiding. How does understanding PPP affect your perspective on the real cost of living and the true economic strength of different nations? It's a question worth pondering. Thanks for joining me on this journey into this essential macroeconomic concept. If you found this discussion valuable, be sure to hit that like button and subscribe to the channel for more deep dives into the forces shaping our world. Until next time, farewell.